All right, let's get right into it. Something really weird is going on in the financial markets right now. You can just feel it, right? There's this tension building. We are smack in the middle of what looks like a new gold rush. But the million-dollar question is this for real? I mean, just look at this. Gold has been on an absolute tear. It's just smashed through all these key resistance levels, hitting multi-year highs. We're talking nearly $2,400 an ounce. For anyone who believes gold is that ultimate safe haven asset, this is the moment they have been waiting for. But this is where things get strange. At the very same time gold is taking off, the stock market, the S&P 500, the Nasdaq, is also hitting record highs. Now, this right here, this isn't supposed to happen. Seriously, these two assets are supposed to be like oil and water. They just don't mix. Think about it like this. Gold is the ultimate fear asset. You buy it when you think the sky is falling. Stocks, on the other hand, they're the ultimate greed asset. You buy those when you're feeling optimistic, when you think the future is bright. So when both are shooting upwards at the exact same time, well, that's a huge disconnect. It's telling you the market has no idea what to think. It's completely torn about what's coming next. And that brings us to the big question, the whole reason we're talking about this today. Is this crazy surge in gold a bull trap, which is just a fancy way of saying it's a fake out, a false signal that's about to reverse and come crashing down? Or is this the very beginning of a new supercycle, something that could push gold to $3,000, or maybe even higher? To get to the bottom of that, we really need to understand the two powerful and totally opposite theories that are battling for control of the market right now. So let's break down this great gold debate. On one side, you've got Team Bull. They are absolutely convinced this is just the beginning of a truly historic run for gold. And in the other corner, you have Team Bear, shouting from the rooftops that this whole thing is a mirage and this rally is about to die a very painful death. Let's dig into what each side is saying. Okay, so Team Bull's argument is built on three massive pillars. First, the Fed pivot. This is the idea that the Federal Reserve is about to completely change course, to pivot from keeping interest rates high to cutting them. The market is betting big that the Fed has to cut rates soon or else the economy tanks. And when interest rates go down, gold suddenly looks a lot more attractive because there's less of an opportunity cost to hold it. Second, China's central bank has been quietly, but consistently, buying up tons and tons of gold. And finally, you have this huge long-term trend called de-dollarization. And this is a big one. De-dollarization is basically countries all over the world. We're talking China, Russia, India, making a conscious decision to depend less on the US dollar. So what do? They start selling off their US bonds and using that money to buy physical gold instead. This is like a slow-moving earthquake under the financial system, and it puts a really strong, permanent floor under the price of gold. But hold on, because Team Bear has a pretty compelling counter-argument. They point out that, yeah, the dollar has wobbled, but historically it's still very strong, and a strong dollar is usually terrible for gold. But their main point is this soft landing idea. What if the economy doesn't crash? If the US manages to avoid a big recession, then the Fed might not need to cut interest rates as much as everyone thinks. And if that happens, well, the main rocket fuel for this gold rally just disappears. So with these two giant forces just clashing, you might be thinking, okay, how would someone even get involved in this? Let's look at the different ways you can play this, because it's about way more than just buying gold bars. There are really three main paths here. First, there's physical gold. This is for the prepper, the person who's all about protecting their wealth. It's the safest way for sure, but it's not exactly easy to buy and sell on a whim. Second, you have gold ETFs, like GLD. This is for the trader. It's basically paper gold that tracks the price, so it's super easy to jump in and out of. And then there's the third option, the high-risk, high-reward play, gold miners. Stocks like GDX are basically a leveraged bet on the price of gold. If gold goes up 10%, these miners can shoot up 30%, but they can also crash and burn. This is pure speculation. But beyond all the trading and the speculating, there's a much more fundamental reason people own gold. It's what I like to call the sleep at night rule. And here's the key. It doesn't really matter if gold is at $2,400 or $1,400. For decades, most financial advisors have recommended a simple, timeless strategy. They suggest you keep somewhere between 5 and 10% of your entire portfolio in precious metals. But why? It's because gold isn't really an investment in the same way a stock is. It's portfolio insurance.
It's that one little slice of your portfolio that's specifically designed to hold its value or even go up when everything else is going down in flames. It's your financial fire extinguisher.
And that brings us to maybe the most important takeaway of this whole thing. This is the core philosophy. You don't own gold to get rich. You own gold so you never go broke. It's pretty much the only asset that has survived every single war, every recession, and every currency collapse for the last 5,000 years.
Which leaves us with one final thought. The smart money, we're talking the central banks of the world, they're showing you, not just telling you, exactly where they're putting their money. They're buying physical gold. So the only question left is, should you follow them?